Glyn, here we are, second month of 2014 completed. A difficult January followed by quite a buoyant February.
Well, it was a buoyant February, but the events of the past few days means that we've sort of forgotten all about that. It was a dramatic turn of events in Ukraine in the last few days of the month and early March, and here we are only on the second business day of March, and we have largely forgotten about the events of February. But it was actually a very good month for risk assets in February, a good solid recovery from the sell-off that we'd seen in the previous few weeks, particularly in January. And some markets, S&P 500, the US equity market, going to a new all-time high. Many markets, equity markets around the world, at multi-year highs. So it was actually a pretty good environment, but disturbed rather by the events in recent days.
Let's take a quick look around the market, some of the cause for the move up in various asset classes before we move on to the obvious sort of elephant in the room, if you like. So developed markets, performance pretty good across the board?
Yes, it was good pretty much across the board. In the US and Europe we saw moves of about 5% upwards. In fact, the only major market that didn't participate was Japan, which actually was down slightly in the month. I think the thing that drove markets was, first of all, we had seen something of a sell-off in January, so there were some opportunities to buy at lower levels, and I think the undercurrent, as we've said for some time, remained pretty supportive for equity markets. But I think also we saw some evidence of a little bit of softening in economic growth in the US, probably weather related, but the market isn't quite sure. As we know, they've had a very, very severe winter in the States, which has impacted on levels of activity. But that little bit of a weakening in activity, I think, is likely to mean that the Fed will be very, very cautious in tightening policy, and that seems to be a major focus of the market's attention. The Fed has continued to taper at 10 billion a month. I've done 2 lots so far, but I think they're going to be very cautious. And with the new chairperson, Yellen, in place, she's made it very clear that the policy will continue, but they will be very cautious about their approach, and it'll be, as Bernanke always said, very much dependent on the data and not simply focused on the unemployment number. And as we know, unemployment's been coming down quite well, but on a much broader range of indicators to effectively provide the information for the Fed as to when they will actually tighten monetary policy. And I think what all of that means is that the tightening is further away than investors were thinking. So I think a combination of reasonably positive things, a longer period ahead of virtually zero interest rates, together with continuing global growth, perhaps a little bit lower in the US than people were thinking, although no signs of any sort of sizable dip in activity. But I think that will extend the recovery period. So all in all, that was seen as a pretty good thing for investors. But the driving force does remain this issue of liquidity, which is going to be around for a long time to come.
You mentioned slowing growth combined with liquidity. That moves nicely onto China. Still plenty of confusing data coming out of China.
Yeah, China, the events in Ukraine and Russia at the end of the month, beginning of March, I think China was perhaps the most intriguing thing that was going on in February. We saw a currency move in the renminbi of, it sounds quite small, 1.4%, but it was downwards. And if you look at the chart of the renminbi, for many, many years now, it's been a one-way upward trajectory. So it's been sort of an easy one-way bet for investors and speculators. It's drawn in huge capital flows. And what we saw in a matter of a few days towards the month end was the People's Bank of China, the central bank, actually pushing the currency downwards. And although small, that was the biggest downward move since the big devaluation of 1994, which in effect sort of presaged the whole sort of big growth era in China. Of course, lots of people are questioning why this was engineered. And it's always very difficult with China because you can never be quite sure. Was it to deter these big capital inflows? Was it because China's getting worried about growth rates? We certainly feel that growth in China is slowing down, and of course a little fall in the currency will help in the sense that it makes Chinese goods a little bit cheaper elsewhere. It will deter to some degree speculative inflows, the carry trade. Or was this part of a move for full currency convertibility, which ultimately we think China will head towards? don't really know the answer to that. Most people seem to think it was all to do with reminding people that the Chinese renminbi is not a one-way bet. So in other words, discouraging the carry trade. Nevertheless, actually, I think quite a significant move, and part of a pattern we're seeing in China, where the new administration is making some quite significant changes in recognition of the fact we are in an era now where Chinese growth is definitely going to slow down. We already know it's growing at less than 8%. I think in a matter of a year or two we're going to be talking about numbers at sort of 5% or possibly lower in China, and the administration is adjusting to that in a series of moves. And as well, we have this issue of, frankly, too much debt in the economy, and the problem with these wealth management products, these trust products that are struggling to survive, and the authorities, to avoid any risk of a sort of systemic credit crisis, are bailing some of these things out. So it's actually a combination of all of these things makes us a little bit cautious about China over the course of this year.
Well, China's currency had one of the worst periods for decades. Elsewhere in emerging markets, the currencies are starting to stabilise a bit.
Yes, we saw some quite good recovery in the currencies. I suppose you'd call them the fragile five currencies mostly, that had fallen very sharp in the preceding 12 months. So things like the Indonesian rupiah were strong, the South African rand was strong in February. Even the Turkish lira, which had been hit very hard, actually rose a couple of percent or so. So some signs of stability in the emerging world, some signs of confidence coming back in. And all of that was actually quite encouraging news. But it was derailed quite a bit in the final day or two of the month and into early March by the events in Russia and Ukraine. And the Russian ruble, I think, was the notable problem currency in that period of time. So far this year it's down about 10%, and in fact the Russian central bank has had to put up interest rates to control that fall. I think what happened in the final couple of days of the month really just took attention away from the good news from emerging markets into this actually really potentially quite damaging move in Ukraine.
Finally then, before we move on to Russia and Ukraine, on the subject of some support again, the gold price more healthy?
Yes. Was that due to concerns about what was going on in Ukraine? Possibly to some degree, although we haven't seen a sharp upward spike in the past couple of days in gold, interestingly. Was it to do with the fact that technically gold had formed a pretty firm base at $1,200 and has recovered quite nicely from there? Again, difficult to know, but gold beginning to behave in its more traditional pattern of something of a store of value, a safe haven in difficult times, and recovering from that dramatic slide that we saw in 2013, and the big selling of gold through ETFs and so on, that's largely gone now. So I think that's behind us. So gold looks much better supported, and I think likely to edge higher. Certainly the position that we have had in gold shares has benefited hugely from this 10% rally that we've seen in the gold price this year.
Let's move on then to Russia and Ukraine. First of all, some sort of top-level observations?
Well, the first thing to note is that I think, as everybody will know, we've had this what appears to be a sort of a bit of a revolution, quite frankly, in Ukraine. The president has been deposed now in Russia. He was a Russian-friendly president, as we know. We now have an interim government ahead of elections in May, and that interim government is more pro-West, pro-European. Russia has responded to that by effectively occupying Crimea, which was originally Russian territory. And Russia has done so ostensibly to protect Russian interests in Crimea. About 60% of the population is in Crimea, remember, is sovereign Ukraine territory at the moment, but occupied by Russia. So you've got a big Russian population in Crimea, and Russia has pointed to a certain degree of lawlessness, a government which is unelected in Ukraine currently. They've referred to extreme nationalist parts of the population. So they are ostensibly protecting Russian interests. What they have not said is this simple fact. that Crimea provides Russia with only one of its only two warm water all year round ice-free ports, and of course the strategic location of that is immense for Russia. Access to the Mediterranean and oceans that they otherwise would not get from their Arctic port, and there is a big Russian army base in Crimea as well. So the strategic importance of Crimea is absolutely clear, and they will not be giving up that anytime soon.
So that clearly brings with it a lot of uncertainty,
Yes.
not just within the emerging market part of the portfolio, but potentially more broadly as well.
Yes.
What's your view on how that impacts portfolios today?
Well, I think the way this will pan out, it's pretty clear. I think that Putin once again has completely outwitted Obama, as he's done on several occasions in terms of foreign policy. And frankly, I don't think there's very much that either the US or the West generally can do about this. There's been talk of sort of diplomatic sanctions, pulling out of G8 summits and those sorts of things. Frankly, Russia won't care about that. The US has talked about potentially sanctions. I don't think there's much support for sanctions in Europe for that. Europe does not want a confrontation. Of course, there's absolutely no prospect of a military confrontation at all, absolutely zero. There's no appetite for that in the US or Europe. And importantly, for Europe, they get a big chunk of their gas supplies, natural gas supplies, about a third of European gas supplies come from Russia, and half of that comes via Ukraine. So there's no real prospect of serious sanctions, I don't think. We've seen quite a sharp hit to the Russian equity market, 7% down in the past 2 or 3 days, and certain European banking shares got hit quite hard, those with big exposure to Russia and Ukraine, risks of a debt default in Ukraine. I think what will happen now is that we'll enter a diplomatic phase. There's the standoff militarily with Russia and Ukraine. I don't think that's going to blow up into something where there's a direct confrontation. I think we'll now get diplomacy. I think the ultimate outcome of this little spat, actually I'd call it a big spat, probably the biggest crisis in Europe this century so far. But the ultimate outcome will be that Crimea will get some degree of autonomy. With a very close link to Russia. Russia will preserve its military bases in Crimea. There will then be new elections for the rest of Ukraine, probably end up with a more West-leaning, European-leaning government, but protecting the interests of the Russian minority. So it'll be a sort of a face-saving thing for both sides, and that will enable Russia and the West to bail out Ukraine, which is facing a very serious debt crisis and the risk of a debt default. So I think over the next few weeks we will see a move towards those sort of end games. But as you say, investors in the meantime will be a little bit nervous about this sort of thing. Do I think it'll have a big impact on the global economy, which of course is very important for the future direction of global stock markets? I think it's very unlikely. I think we've seen the biggest part of the immediate impact. There'll be certain companies and sectors that might be affected by this, but I don't think this is going to be big enough, particularly with that end game that I referred to. I don't think it'll be big enough to see the global economy being derailed. If anything, I think this type of thing will mean that central banks will be even more cautious about thinking about tightening monetary policy, so ultra-loose monetary policy for longer, supportive of equity markets. So I think we'll go through a nervous phase here, but I think the underpinning for equity markets remains pretty good. One final thing I would say is that Russia, many people have said for quite some time, has been one of the cheapest equity markets in the world on a very low rating. We're reminded why. This is not a risk-free place to invest.
Absolutely. Thanks, Glyn. It's just worth recapping. It's the 4th of March, so it is early days in this process, but no, thank you very much for that.
Pleasure.